have my own views of the stock market, and I talk to people who have positive views and negative views. They think either the market is going to keep on going up for quite a while, indefinitely. They don't know how long, but they have a positive view. And there's others who think a crash or some kind of a significant pullback is right around the corner. I'm going to cover that. I'm going to cover both sides of that. Then there is the macro view in the space of time, in the space of decades, maybe even the space of a century. Where are we? What is coming? And when is that going to happen? I call that a macro view. So I'll cover short term, positive and negative, and I'll cover macro. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is March 26, 2024. And I do this several times, I'm going to play both sides of this. The first I'm going to play is a kind of a more balanced, maybe a little bit more of a negative view, but not horribly negative, of what the future of the market is. We're kind of at an inflection point of, is it going to go up from here? Because it's gone up for quite a while. Is it going to keep on going up, or is it due for a correction? And so this is an interview that Tyler Matheson does with Mike Bailey and Ron Insana, and they will give their views. The question is to them, are we in a bubble? In other words, are we at a point where some kind of event happens and the bubble collapses? It pops. And there's the thought of bubbles. Their view is, yes, we are, but it's not going to pop yet. We're in an uptrending, but there is a correction that's in front of us, but not horrible. And I agree with that. But a bubble is actually forming, and it is going to convey risk in the future. More upside, it seems, but you and I know this is not going to go to the moon. But there is a level of complacency that says nothing to worry about in the market right now. So both of them weigh in on this. Very reasonable thoughts. I happen to agree with their perspective. So take a listen to Tyler Matheson interviewing Mike Bailey and Ron Insana.
Joining us is Ron Insana, CNBC senior analyst and commentator, also chief market strategist at Dynasty Financial Partners. And Mike Bailey is a director of research with FBB Capital Partners. Welcome to both of you. Mike, let me start with you. In the last hour, Michael Farr, another Michael, called today's market bubbly, but not a bubble. So I guess carbonated, but not overflowing. What's your view?
I think that's directionally correct. I think we're probably closer to a bubble now than we were, let's say, a year ago. I think the question is, will it pop? I think we certainly saw a little bit of a bubble pop in late 21. Everything was going up. There was, irrational exuberance, et cetera. We have to scroll ahead and say, well, what's going on right now? Are there real fundamental reasons driving the market? Let's go to AI. Let's look at NVIDIA. I mean, they are generating massive growth. These are real dollars. They're real huge companies are buying these chips. There's a whole ecosystem around it. So we are seeing a lot of dramatic growth out there. Mm-hmm. Yes, that is driving earnings up. That's driving stock prices up. Are we in a bubble? I don't think we're quite there yet, but I think we're definitely getting closer. And I think investors really got to be very careful about what they're buying. If they've got something that's really moved up, start to think about rebalancing. But so I think
there may be, Ron, portions of the market that are in bubble territory, if you want to call it, but others that are not so inflated.
Yeah, I mean, much of the market's not inflated, right. Although we have seen a broadening of late, and so markets, areas of the market that have been underperforming, small caps and the like, but starting to turn higher. A bubble's a very specific word. It implies a lot of things, including public euphoria, heavy issuance of new stock, which we've not seen yet. We've seen a little bit of it starting to take place now, but
well, there's certainly euphoria surrounding AI and
Yeah, although
a lot. I mean, what do you people go? How about Nvidia? Man, that's what people talk about. It's like CMGI 25 years ago.
well, no, I mean CMGI had zero.
I got you.
Business.
I
Being a
got you.
publicly
But
traded company.
no, I understand that. These
had
were
one
not
piece,
real.
Lycos that actually got sold to somebody
But
else.
the stock performed as though the stock was the darling.
Oh, absolutely.
At the
David
time.
Weatherall was a billionaire. I remember we
Yeah.
sat, Sue Herrera and I sat with him at a Fidelity event and asked him what he was going to do now that he was a billionaire, and he said he was going to get a plane. So that was frothy, and that was even early. That was like 97, 98.
Yeah.
So bubbles inflating. I mean, we're in the infrastructure phase of the AI build out. We haven't reached the implementation phase, which is going to start coming, I think, in waves now. And you've talked to venture capitalists who are looking at the implications for healthcare, financial services, wide variety of different businesses. I was doing an interview yesterday at an event, and even not just the news business, but the legal business, that profession, everything's going to be touched by it. The question is, how do markets respond, and when do we see the type of euphoria that we saw between 1995 and all the way through 1999 into early 2000? I don't think we're quite there yet.
So if you're of the view, you have a perspective and you believe you don't like negative news, you don't like talk of downside risk and that sort of thing. You really you have a view that is a positive view of the market. It generally speaking always goes up. And you want to hear people who talk about that and support that position. I'm going to show that to you. So Nick Colas is being interviewed by Joe Kernan, and he will give you the reasons why that position makes sense. So this is sort of giving you a little bit of two perspectives. Both of these are what I would call short-term to intermediate term. So take a listen.
Talk more about the markets. Joining us now is Nick Colas. He's co-founder of Data Trek Research. Is sentiment reflecting what we just talked about? What did you say, Nick?
Sentiment in terms of, say, how retail investors feel about the market?
How much after the most hated rally in history last year?
Yeah.
I still don't feel like people are as bullish as we've seen in previous, what would form a top, are they?
That's absolutely true. We've just seen money flows turn positive in mutual funds and ETFs in the past couple of weeks. They're still down on the year for U.S. equities. So we're maybe 2 weeks into some kind of interest in the market, but nothing more than that.
Looking just at since the pandemic, I mean, if you could find a way for the market to do what it's supposed to do, and that is confound everyone, we close the economy and the S&P doubles. And all these pandemic beneficiaries take the NASDAQ to new highs. Then we consolidate. How long? For like 2 years. We went down and consolidated, and everyone thought we were going to have to test the lows, which we never did. So where are we now historically? Are we headed to significant all-time highs in the next couple of years, do you think?
The short answer is absolutely, in my view. Absolutely. We're in what I call a mid-cycle market. We're not in a recession or close to one, and we're not facing something that's going to be pretty dire. And those broad middle parts of the market, 82 to 89, or the 1990s, or 03 to 07, or 2012 to 2019, these are all long periods of economic expansion and stock market growth. In all those years I just mentioned, there's only one down year. It was 2018, that was down 4%. So we're just starting that phase.
Why
now.
in the world would the Fed be cutting interest rates in an environment like that?
Well, the Fed had to jack rates to fight inflation, but they're, I think, quite scared of cutting too little in the face of what is now a slowdown in labor markets. We're beginning to see some of those cracks form in labor markets, particularly at sort of the top end. And so they don't want to be blamed for the next recession, particularly going into an election year. That's why Powell pivoted in December to 3 cuts from 2, and that's why they're staying with that messaging now.
So that's the short to intermediate term view. Now, I'm going to back away and give you another perspective. This is a macro perspective. So when we look at the context of decades, we can see where are we? We are in an extended, I don't want to say hyper extended, but definitely extended market condition when viewed over decades. When you look at a chart, you would say clearly the market is extended on the upside. Therefore, what is next is at some point is a collapse. There are 2 people I want to play, separate views. Played both of them before. One is Jeremy Grantham, just about 1 minute from Jeremy Grantham. And then secondly, from the famous money manager, Jim Rogers. And both of them are north of age 80 and have been doing this all of their lives and very successful. You could not argue with this, the accuracy of either one of them when it comes to managing money. I won't go into much detail on that, but I'm going to begin with Jeremy Grantham and his view. Now, keep in mind, he has a negative view, and his view is we are building a bubble, and the bubble's going to pop, and this is going to collapse, and it's going to be horrible. He is not talking about tomorrow. I believe, and based on the video that I did last week from Felix Zulauf, he's probably talking over the next few years. But we are at a point where the market is so overbought and so overextended, the price-earnings ratio is quite high, and both of them, Rogers and Grantham, both talk about the debt. The U.S. debt is so high and so unsustainable that something is eventually going to have to give. So I want you to hear this from a macro perspective and from someone like Jeremy Grantham, who has, in my opinion, a lot of credibility. So take a listen to Jeremy Grantham.
All I do is look at the history and say the best guess is that a bubble will behave like a bubble. And the more remarkable meta-level question is how come people can get away with saying nobody saw it coming? Each time, nobody saw it coming, when the data is screaming that you can't possibly miss it. You first semester course of statistics, you could not miss 1929. You could not miss 1972. You absolutely categorically could not miss 2000 when it went to 35 times earnings. The previous high PE had been 21. It went to 35, for heaven's sake. In Japan, it went to 65. No, you cannot miss these bubbles. And you could not miss the one in 2021. It went to a peak that rivaled 2000. And in some ways it was cheaper, some ways it was more expensive, but it was a very, very obvious bubble. Do not tell me that you can't see these things. And they all break, no exceptions. And if you say that, you'll be called a permabear.
So finally, I want to play a piece from Jim Rogers. Jim Rogers came into the business back in the 1960s, became kind of a contrarian to Wall Street, what he was being told. And during the 70s, he and his fund, the Quantum Fund, made, I think, 4,200% return, crazy number, 4,200% return for their investors. He made enough money out of all of that by age 37 that he retired and has been retired ever since and is now 80 plus. But he is sought after for interviews. He left the U.S. He sold stocks and the dollar and so forth, bonds. He sold everything in the U.S. This is about 10 years ago, and went to Singapore. Still lives in Singapore. So he's an independent thinker. He tends to invest. He looks for opportunities. A lot of times he's looking for opportunities on the downside so that he can short various investments. This is for his own portfolio. And, but, you know, through all of that period of time, from age 37 to age 80, he has been successful with his own investments. And he tends to look more internationally, and he tends to look more on the short side, so the inverse side. So, but his views are always interesting, and I'm glad that he still does interviews. He says that we are not yet at the top of the market. It still has a ways to go, he believes. And he is careful to not use time frames. And he's careful to not say we are 6 months away or a year or 5 years or whatever. He says whenever this happens, here's how it's going to go, he believes. And he has said this, he says it on almost every interview. I I hope I'm smart enough to recognize this. That's one thing he says. And secondly is, I don't know when it's going to happen. I don't know when. But whenever it does, it will be the worst crash in my lifetime. And that goes back through the 73-74 crash, the 79 to 81 crash, the 2000 crash, the 2008 crash. Goes through all of those. This will be worse. And whenever it happens. So this could be 10 years from now, could be a year from now. We don't know. And so he makes that very clear. But he does say we are getting closer and closer. We have our own method of, we are tactical. So like Rogers and like others, our method's different, but we do get out of the market when we sense that mathematically, sense that risk is coming into the market, and that's how we manage money. And he takes it a step further. I don't know what method he uses, but when those conditions occur, he goes into a short position. He's betting against the market, and he usually does it based on particular sectors, the sectors that seem to be the most at risk. He's obviously a very smart guy. I don't know what method he uses. I don't know if it's his gut feel or mathematical. But anyway, he says we are getting closer. But again, just like Jeremy Grantham, he is taking a macro view. So it's negative, but the market goes, you know this, the market goes up and it goes down. It goes up in short periods of time and down in short periods of time. And then in longer periods, it goes up quite a bit and comes down quite a bit. These are cycles that it must go through. So he is speaking, just like Grantham is, he's speaking about the macro cycles. So, and he's entertaining. I think he's a colorful personality, but he's also been immensely successful. So take a listen to Jim Rogers.
Just let me quickly clarify what I have said, and I will say again, the next time we have a bear market, and I don't know when it's coming, at Thoughtful Money they know, but I know we're going to have more bear markets, and I know that the next one is going to be the worst in my lifetime. 2008 was a problem because of too much debt. Look out the window. Since 2008, the debt has skyrocketed everywhere. Even China has a lot of debt now. So all I'm saying is, and I don't know when it's coming, that the next time it's going to be a nasty, horrible, disastrous bear market. Now, how I see the world right now, one of the things that history has taught us is the year before an American election, usually the American market is fairly strong. And that's because all the politicians know the election is coming, and so they try to make everybody happy. And it's happened again. I mean, we had 2023 has been a reasonably good year in most markets around the world, but we're talking about Americans, certainly in the American market. So now what? Your question is now what? Yes. It's great for 2023, but what about 2024? Well, first of all, it's the longest period in American history without a problem. We have never had such a long period. Doesn't mean it won't go on 40 years. I have no idea. It never has, but who knows? But I'm starting to see signs. And by the way, I have not sold anything short. I do have a lot of cash, but I've not been shorting. I'm starting to see signs. You see the signs that fewer and fewer shares are going up. They go up every day. Some shares go up every day. A lot of new people are coming into the market, inexperienced people coming in, and they all talk about how much fun it is and how easy it is to make money. Well, it's never been easy for me, but if it's easy for somebody, that's probably a bad sign. So I see some of the signs. The debt is skyrocketing, some of the signs that have happened before. So I'm worried, but I'm not shorting yet. Often at the end of a long bull market, there's a blow off, where everything just skyrockets. I don't know if we're going to have one again, but I'm waiting in case we do. And I hope I'm smart enough to short it if it happens.
Okay. Yeah. Just keeps going and going, like the Energizer Bunny, says the bear. So the market, the bears are kind of sitting on the sidelines, watching the bulls continue to dominate the market. Is it going to keep going? I don't know. I think some of both. I think we're going to see some downside. I don't think it'll be horrible. I think normal pullback. I think we'll see some of that. And I think we're going to continue to see some upside before we get to the point of a collapse. So if you have a method, I say this to not so much to my clients because they know what I do, but to those who are not my clients, I say, if you have a method to preserve your money or preserve a good portion of your money, good for you. Stay with your method if you have a method you believe in. If you do not, what I would tell you is be prepared. Prepare yourself financially and emotionally for the roller coaster that is likely in front of us. When it is a deep decline and probably a steep increase that goes beyond that, be prepared for that. If you're not, think about it. Thank you for watching. If you have questions or comments, leave them in the comment section below.